This is the Net Group Investments podcast, where we explore a variety of views and insights that investors care about.
Good day and welcome to this edition of Net Group Investments Insights with me, Mohini Naidu, as your host. Now, investors in our Opportunity Fund, part of our Flagship multi-asset range, will no doubt be familiar with its lead portfolio manager, Omri Thomas of ABAX Investments. But today we've invited Steve Minar, also a portfolio manager at ABAX, to talk to us about his recent trip to China and some of the global markets where the Opportunity Fund is finding investment ideas. Steve, welcome. It's great to have you in studio today.
Hi, Mohini, also to the listeners.
Steve, now, while Omri is the lead portfolio manager and has ultimate accountability for the fund's positioning and performance, the ABAX Investments team has a depth and breadth of experience across varied asset classes, including global equity, where you manage the offshore portion of the Rainmaker Fund. And so other portfolio managers at ABAX may look to you when assessing global opportunities for their specific mandates. Now, you recently visited China on a research trip. What were ABAX views on China before that, and did this trip help to strengthen your investment thesis?
Yes, thanks, Mohini. China is always, it's a big country, it's complicated. And whereas we saw in the rest of the world a huge resurgence in consumer spending after the lockdowns of COVID, China has really underwhelmed. And last year was particularly disappointing for foreign investors, where the so-called revenge spending just never happened. In addition, we've had global wars, so geopolitics have also risen. You know, there's a strong feeling of Sinophobia that's bipartisan in the US. We've seen tariffs being introduced. So it really made life quite tough for China. So what we wanted to see or get more information on is to find out what does it look like on the ground at the moment. Does a consumer really stop spending? Will they ever start spending again? And if so, by how much? So JP Morgan has a China summit every year, and it's really a flagship conference, not just for them, but also for investors from around the world, and really a significant group of panelists that they have that spoke about a whole range of issues. The bottom line for us is that the consumer in China is indeed not dead. There is plenty of money. As a matter of fact, the number $19 trillion, I'll say that again, $19 trillion of pent-up savings. Not just after COVID, but obviously it's gone for many years, that the consumer has in its armor. They don't feel very sort of happy to spend their money at the moment. You might have heard about the housing crisis that you've had in China. And again, it was well meant by government. They tried to uplift hundreds of millions of people from rural areas, from poorer areas, also reducing some of the shanty towns in the big cities. And the housing market has really just been overbuilt to the tune of about 300 million square meters that are sitting finished but not being sold at the moment. And that's really hurt the pockets for lots of these consumers. They don't feel happy about their savings, so therefore they don't go out and spending. But that will change. And we've seen several smaller examples where the consumers already started to spend. The government also announced a whole range of initiatives as recently as the 17th of May to make it easier for people to buy properties, to buy second properties, lower deposit rates, also lower mortgage rates. That just made it more attractive, and hopefully that will just give a little bit more confidence to the consumer to start spending. In addition, what China has done over recent years is a whole national, we don't want to call it a nationalization, but they really want to be more proud about what they do inside China for China. They don't just want to be seen as a producer of cheap goods for the rest of the world, whereas that helped in the last couple of decades to really uplift the economy in China and also to export deflation very favorably to the rest of the world. What China now wants to do is design in China, for China, and move from just Chinese products to Chinese brands. And we're really seeing that across the range of products, services, and very strong Chinese brands that are now starting to come to the fore. And we do believe that those will stood the market in good stead over the years to come, and the consumer will definitely take part.
Steve, you mentioned geopolitics and you spoke about the property market. I think we're all quite familiar with some of those issues. But what are the other risks of investing in China that is making it trade so cheaply relative to the rest of the world, developed and emerging markets included?
Yeah, there's a range. We don't have time to talk about all the factors. The biggest one at the moment is just geopolitics. The US has dominated the world's economy for many years. They've been seen as sort of the final savior on a white horse to come in if there's any, political strife. And now all of a sudden you have an upstart, if you can call it that. If you're US, that's what you will call them, coming out of China. And they're definitely the second largest economy, if not larger than the US already. And that upsets the Americans. And there's bipartisan xenophobia. They don't want to see China as being a global leader on a range of issues. That has just significantly upped the equity risk premium for foreign investors to invest inside China. So whereas you would have paid X before, you probably now have to pay X plus something for exactly the same stock with exactly the same potential.
Now, the Opportunity Fund had about a 5% position in Chinese stocks as of the end of April this year. In which sectors are you finding opportunity, and how do you mitigate against those risks that you mentioned now, including geopolitics, where it's very much a wild card as to the range of multiple scenarios that could play out?
Thanks, Mina. That's a very valid question. So what we do is we try and shy away from companies that are specifically dependent on having to make large exports. So if you had an export company and all of a sudden the US introduce a 100% tariff, then you have a big issue. So we prefer companies that operate in China, for China, by China, to the local consumer. So they're not dependent on exports, they're not dependent on foreign investments, they're not dependent on foreign products or logistic chains. They can basically operate even if the walls around China seems to be lifting to some extent. So those will be typical consumer plays. It varies from online travel, be it from local to outbound, although we focus more on the local. Also, the electric vehicle market has just gone explosive in terms of the number of electric vehicles. They really do have very, very deep technology and expertise. There are a whole bunch of companies on that side that makes it very attractive to invest there. They also have very good financial companies. Again, there we wouldn't necessarily buy all the state-owned banks because the regulations are very different and you don't want to be caught sort of unawares of local changes. But there's a whole range of companies that provide individual components to the fintech industry that we find quite attractive.
Steve, thank you very much for your time today and sharing those insights with us, and to you and the team for the great long-term performance that you have delivered on the Nedgroup Investments Opportunity Fund.
Thank you very much.
This podcast is for marketing information only. The information contained in the podcast or video was for information purposes and does not constitute advice, recommendation, or an offer or solicitation to purchase or sell any funds or strategies to any person in any jurisdiction in which the offer, recommendation, or solicitation to purchase would be unlawful.